By 2026, sticky inflation and global friction have left investors scrambling for somewhere safe to park their capital. For centuries, the ultimate safety net has been gold. When the purchasing power of paper money erodes, the mathematical reality is gold holds its ground. If you spend any time on financial social media, you've probably seen the fantasy. Traders flash screenshots of massive overnight gains on the XAUUSD chart, treating the asset like a guaranteed ATM. Let's look at the exact breakdown of those numbers. A 1,000 pip gain looks incredible on the left side of the screen, but if that trader had to risk half their total account balance to survive the swings, one bad trade wipes them out completely. Now watch the math change. A smaller 400 pip gain, executed with a strict 1% risk limit, generates a 400% return on the capital actually risked. Surviving gold's sharp volatility means dropping the casino mentality. You need a disciplined, top-down framework to actually measure what moves the price. Before you even open a chart, you have to understand the invisible forces pushing the market. Gold responds to global macroeconomic data and central bank policy. Because gold is priced in US dollars, the two share a strict inverse relationship. When the dollar gets stronger, it takes fewer of them to buy an ounce of gold, driving the XAUUSD price down. Then there is the cost of holding it. When central banks like the Federal Reserve raise interest rates, institutional investors pivot away from gold, which pays no interest, and toward higher-yielding government bonds. This makes the Consumer Price Index, or CPI, a critical metric. A higher-than-expected inflation reading often triggers sudden upside rallies as traders bet on gold's value-preserving qualities. Professional traders weigh these inflation reports alongside global tensions to form a definitive macroeconomic bias. That fundamental analysis tells you exactly why the market should move in a certain direction, establishing the context you need before executing a trade. Once you have your why, you need your when. This is where technical analysis filters out the noise to pinpoint your exact entry timing. Instead of relying on arbitrary lines on a screen, many modern traders use inner circle trader, or ICT concepts. This approach tracks the algorithmic delivery of price. Price acts like a magnet, drawn to liquidity pools where retail stop-loss orders are trapped. Notice this distinct vertical void, a fair value gap. A high-probability setup involves waiting for the trend line to return precisely to fill that gap. But these precise technical formations are only statistically valid if they align perfectly with the macroeconomic bias you already established. Waiting for that perfect alignment filters out low-quality reactive signals. It dictates the exact timing of your execution. Now we drop down to the micro level, the actual mechanics of the trade. This is where gold's extreme volatility destroys unprepared retail accounts. This visual equation breaks down the unique pricing structure of XAUUSD. A single $1 move in the asset's price, say from $23.45 to $23.46, is equal to exactly 100 pips. Understanding that scale is the only way to calculate accurate position sizing. You must limit your capital exposure to a strict maximum of 1 to 2% on any single trade. And your protective stop-loss order cannot be based on an arbitrary psychological threshold. It must be placed at a level that invalidates the actual market structure. Precise mathematical execution is your only viable shield against margin calls. A successful gold trader in 2026 isn't trying to double their account overnight. They prioritize compounding consistency over high-risk gambling. A mathematically sound target is a sustainable, systematic return of 2 to 5% per month. Achieving that requires absolute emotional discipline. You have to maintain a highly structured approach, resisting the urge to manually override your own risk parameters in the middle of a trade. To execute this comprehensive macro-to-micro system, you need institutional-grade technological tools. Head over to the FXNX platform to utilize advanced charting tools, track market strategy with 0.0 pip spreads.